Hello friends, welcome to the Shikhar series for BFM. In Shikhar series for BFM, we are covering all the objective questions, numericals and theory wherever it's compulsory. In the questions only I am covering various theory parts. So follow the video completely, share it with your friends, like with your friends. Okay, so let's start. Here I am covering ABM and BFM. Today I will be covering BFM part. Okay, so let's start. Okay. Which of the following off-balance sheet exposure items come under the low risk categories? Here, understand the question properly. Which of the following off-balance sheet items? Okay. So already it's given. These are off-balance sheet items. Already it's given. Now out of that, we have to check which of these off-balance sheet items are low risk and medium risk. I mean basically low risk. Question over here is of low risk, but I'll give you the idea about medium risk also. Okay. So, which of the following are under low risk? Swaps, LC, money guarantee and indemnities. Let me see. Because what happens, many of us think, we feel that swap, big name, because we don't know. Many of the bankers retail, we are in retail banking. We don't know what is swap. We feel very difficult. So that's why. Which is this? Low risk? No. This will be of high risk. LC I know something. I've heard about it. So LC, yeah, it is in low risk. Money guarantee, okay, low risk. Secondary payment. Then what? Indemnity. Indemnity, I give it in FD. It is low risk. So which is the correct answer then? So look at this. The correct answer is swaps. Totally reverse. What you are thinking is totally reverse of that. Swaps are the lowest risk. Okay, why? Why lowest risk? What is a swap? Swap is always the exchange between two cash flows, streams of two cash flows. Okay. Basically, in your numericals, I'll tell you swap means what? It's the exchange between the spot rate and the forward rate. See, the swap means it's the exchange between spot. What is the present thing? Spot rate and forward rate. It is the exchange between these. Okay. In swap, always remember one leg is fixed. So in this, which leg will be fixed? Fixed means which I know. Which I know. Right now, I know this on the paper. I can see this. So that is spot. Spot is fixed. Because this rate is known to you. And what about the forward? Forward is unknown. You are guessing. You are guessing the rates. So this is unknown. So this is floating. Okay. Got it? So spot and forward. Got it? So fixed and floating. So that's why spot is the lowest risk. You'll say, sir, you are only giving you half knowledge. Spot is, this is low risk, then what is the high risk? Isn't it? Natural question will, so we'll categorize it. High, medium, and low. Let's do it. Okay, where you have the full responsibility on yourself, complete responsibility. Where do you have complete responsibility? All these three. Complete responsibility. Understand, here I am talking of LC issued by the bank, bank guarantee issued by the bank, indemnity given by the bank. I am not talking from the customer side. Here I have given all these things as a bank. So this becomes a primary mode of payment then. LC, these are all you have to pay compulsorily. So this is the high risk. Which is a medium risk then? Medium risk means where someone else is involved. 50% risk is on that person, 50% on me. Medium. Which is that? Performance guarantee. Performance. In performance guarantee, what happens? Whenever bank issues a performance guarantee. Okay, here I am talking of money guarantees. Okay, understand the difference now. Money guarantee, there is also something called as standby guarantee, general standby guarantees, financial guarantee. These are all under high risk. And whenever I am talking of performance guarantee, it means someone else is performing. In that case, it becomes medium risk. Why? Because if he doesn't perform, somebody is building a road, I give a guarantee on his behalf to that government body. So if he does not build the road, then only I'll have to pay. So there is someone who is doing something, right, related to performance. And low risk means all these, where you are just juggling with this money. Very low margins are there. That's why what happens, these are of low risk. All these swaps, forwards, FRAs, these are all low risk. Okay, got it? So these are the three categories. Got it, everyone? Clear? Type yes in the comment section. Is it clear, everyone? Yeah? Chalo, next. Use forward rate agreements. Okay, topic for today is this, derivatives. You have seen the topic now? This derivatives now. So we are in this. Use forward rate agreements, swaps, options, financial futures to construct synthetic securities and does hedge against any exposure to the interest rate risk. Means, what is this FRA? Use forward rate agreements, swaps, options and financial futures. First part of the question is over here, up to this. What are we talking of over here? Here we are talking of 4 different derivative products. FRA, swaps, options and financial securities. So these are 4 different derivative products. Okay. These are known as simple derivatives. Simple means what? All these, if you see, these are simple derivatives. Means what? There are only 2 legs. One is this, one is that. Fixed leg, floating leg. Spot, future. Like this. So these are simple ones. But what is the question? The question is use. We are using this combination. Means I am combining forward rate with swap, or futures with FRA, or futures with swap, something like this combination. So use the combination to construct a synthetic securities and does hedge against any exposure to the interest rate risk. Exposure to interest rate risk. So which one? All of them? See this? 1, 2, 3 and 4. Let's call this A, B, C, D. Okay? All of them. So do we use FRAs for constructing the synthetic securities? What is synthetic security? See, the synthetic security means it's a combination. Kindly note this. Synthetic means it's prepared. Synthetic security. So it is equal to FRA plus, let's say, swap. So combination of these. FRA plus swap, or anything it can be. FRA plus forward, or swap plus something else out of these 4 options. Okay. So you can use it, all of them. Okay. All of them over here. So I think so. 1, 2 and options and financial futures. These are combined over here. So the answer is all A, B and C. Got it? When the buyer has to pay the interest in rupees and principal in USD, the borrower may hedge the interest rate, only the interest rate, and it is known as, what is this? Now we come to something difficult. Okay, we are coming to something difficult. What is this difficult? Let's see. See this. Here we are talking of the buyer has to pay. Pay means what? Understand the term. Here we are talking of a Bharatiya firm, Indian firm. Indian company. This Indian company has taken money from some foreign company. Understand the problem correctly. It has taken the money from some foreign company, let's say USA. Now this USA guy has given the amount, okay, to this Indian company. Now look at the case. The Indian company has to pay the interest in rupees. So interest I have to pay in rupees, and principal I have to pay in dollars. Now which hedging will I use? Which swap will I use? All this swap is basically for hedging. So which swap will I use? Will I use principal only, currency only, coupon only, or interest only swap? Which will I use? Now I'll tell you what the problem is. All of you will get confused over here. Many of you might have thought of that answer as this or this, A or D, principal only swap, because what you are thinking, array, principal I have to pay in dollars, I have rupees, so principal is the problem, dollar might go up down, so I'll be using that swap. Some of you might have thought that no, interest rate, name itself interest rate is to be paid, interest is to be paid in rupees, so interest only, simple, isn't it? Both are wrong. Both are wrong. Okay, what is the answer then? Both are wrong over here. See here this person has to pay compulsory interest. Compulsory interest means what? It's called as coupon. When you're in any bond, there are 5 terms. Which are the 5 terms? Tell me. Which are the 5 terms in any bond? Number 1, face value. Right? Second one, coupon, and third one is tenure, right? Period of that bond, remaining period. Next, market rate and market price of that bond. So these are the 5 terms. Out of these 2 change, always change, and these 3 never change. They are always fixed. Change. But understand this. Coupon is also interest only. Coupon is also interest. And this market rate is also interest. Both are interest. Okay, but this is compulsory, not changing, and this is changing. Okay, so these you might be knowing all these things. Okay, because you have already done this. So it was just a revision for you. So now the point over here is, what is this? So now the point over here is, which one? So the point over here is, what is the answer then? Okay, let this remain as it is. So now what is the answer? The answer over here is coupon only, sir. Coupon only. Why coupon only? Because this person has to pay in dollars principal. Now this USA guy will accept it in dollars. He had given money in dollars. You are paying in dollars. So dollar adjusted, no change. But here in interest you have to pay in rupees. Now this is the problem. There you might face the problem in this forex. If I am getting the money in dollars, using it in dollars and giving it back in dollars, no issues. But if I am getting it in dollars and paying it in rupees, then there is the issue. So I'll have to use this swap of coupon only, not anyone else. Got it? Which of the following is a potential cost of adverse movement of interest rates that a bank faces on its deposits, borrowings, lendings, or interest rate derivatives? So which of the following is a potential cost of adverse rate movement? Cost of adverse rate movement of interest rates. So interest rate is going up or down. Okay. So where will I face the major NII difference or spread difference? Where will I face the income difference? Think: legal risk, operational risk, interest rate risk, country risk that a bank faces on its deposits, borrowings, lendings, or interest rate derivatives. What is the answer? All of you have thought of one answer, I know. All of you are thinking that interest rate risk. But then your second mind says, such a easy answer, how is it possible? Interest rate, such a, no, kuch to gadbad hai. There is some problem. Interest rate risk is not the answer. So what will you do? You know this answer is correct, but you will mark something else. Why? Because you are thinking, how can the question be so simple? But actually remember, almost 60% of your BFM questions are straightforward, simple. So the answer is interest rate risk only. That is the answer. See here, on your deposits, borrowing, lending, interest rate derivative, everywhere you face the same interest rate risk. What is this interest rate risk? What do you mean by this? Chalo, type in the comment section, everyone. Let me see. What is the interest rate risk? Yes. Give me in one line. What is the interest rate risk? In one line. See here, interest rate risk means interest rate. Look at this. Very important. See here, these two risks are always related. Which is this interest rate risk and second is price risk. Price. These two risks are always related to each other. Price risk and interest rate risk. Always related. Why? Because it's like this. What is the interest rate? Interest rate means any benchmark rate. Let's say repo. If RBI tomorrow increases the repo, then what will happen? You'll always face the problems now. In that case, what happens? Your deposit rates will go up, your loan rates will go up. Reverse case, if RBI tomorrow decreases the repo rate, your deposit rates will be down, loan rates will be down. So that is the interest rate problem. But also there is one more problem regarding this price risk. This price risk is related to the bond prices. Bond prices. You all know how big this bond market is. Debt market is the biggest market in the world. So bond prices are negatively affected by the prices. Means what? If the interest rate goes up, the price of the bond will go down. Always. And reverse is also true. If the interest rate goes down, the price of the bond will go up. Okay? That's why you see in the present situation, some of the countries are facing huge inflations. Even US was facing the same inflation. Okay, UK, England, Germany. Okay, these all countries are facing inflation now. Because of that COVID, during the COVID, they distributed the money. Okay, so that's why they are facing the problems now. So now, the point over here is, because of this, the central bank has to increase the interest rates. Here, whenever the inflation is high, kindly note this, I'll give you a simple logic now. You should be very clear in your BFM in this part. Okay, so I'll give you a simple logic. If the inflation increases here, if inflation goes up in any country, inflation goes up, okay, what will happen? The first thing your central bank or RBI will do is increase the interest rates. They will increase this interest rates. This is the cause and this is the solution. So this is the solution. So RBI will increase the interest rates. But if they increase the interest rate, what happens? Your bond prices fall down. So bond prices fall down means what? Those who have purchased the bonds earlier, their prices are down, so they are in losses. So immediately the bond prices go down and people face losses. This is a linkage always. Kindly remember this. Okay. Inflation up, RBI will immediately, RBI or any bank, not only RBI, any central bank in the world, it will immediately increase this repo rate. Repo or whichever benchmark they are following. They will increase the benchmark rates. Okay. Next. So you got the answer. The answer was interest rate risk. Clear everyone? Move on. Type yes in the comment section. Which one of the following is not a type of foreign exchange derivative? Very tricky. Not. Let me see. Foreign exchange forwards, currency exchange future rate, cross currency option, foreign currency rupee swap. Now let me get the answer from you now. Let me see. Let me get the answer from you. What is the answer for this? Not. You want not, which is not a derivative. Forex derivative. Very tricky one. Let me see in the comment section. What are you answering? Yeah. Think. Everyone think. Very simple answer. Very simple. Yes, it is very simple answer. So the answer is this. Currency exchange future rate. Okay, let me explain you. See this. Foreign exchange forward. Forward is a type of derivative. Kindly note. These are all the names of the derivatives. Forward, option, swap. These are all the names of the derivatives. Even future is a derivative. This is also a derivative. Then you will say, sir, if this is derivative, then how are you saying that it is not a forex derivative? Because the real word over here and real catch over here is this. This is the real catch, which all of us are missing. We are reading these three words, but we are not reading this word. This is not a derivative. This is simply a rate. This is my forward rate. This is my future rate. $1 today is, let's say, $85. $1 after, let's say, 4 months or 3 months is $88. 88 rupees. Okay. So this is simply a rate. How can it be a derivative? Derivative means what? Kindly note, in any derivative, there are two things. Okay. One is risk involved. Risk involved. What is the risk involved over here? I am telling you. After 2 months, the rate of this flat will be, whichever flat is, will be, today it is, let's say, 1 crore. After 2 months, the rate will be 1.25 crores. What is the risk? No risk. It's the rate. You want to buy it, you buy it. You don't want to buy it, you don't buy it. Isn't it? So, future rate, this is simply a rate given. And kindly note, in any derivative, there is always a risk involved. Some risk should be there. It's always a juggling. Any derivative is always a juggling between present and the future. Always. There are always two legs in any derivative. Like in swap we have, similarly in forward also we have. Similarly in future we have. Similarly in options we have two legs. So everywhere you have these two legs. One is fixed, second is floating, or we don't know. Okay? But this rate is nothing. Rate is simply a rate. Movie ticket rate. What is the derivative in this? Nothing. Okay? Derivative contracts that are traded directly between two eligible parties are called. Now, which derivative contracts are traded directly between the two parties? Over-the-counter derivatives, exchange traded derivatives, direct derivatives, and spot rate derivatives. Think. Which of the derivatives are traded actively between the two parties? Which derivatives? Actively traded between only two parties. Then I'll give you the explanation also. Over the counter, exchange traded, direct derivatives and spot derivatives. Answer is comments. Let me see in the comments. It is over the counter. Kindly note, OTC, there are two types of derivatives. One is ETC, exchange traded derivatives, and OTC, over the counter derivatives. Okay, what do you mean by this? See this. In OTC derivatives, there are only two parties. Like, I'll give you a simple example. When you give a loan to any customer, which are the parties in that loan? You and the customer. So, there are only two parties. So, two parties over here. Two parties. Buyer and the seller. Buyer and seller. Okay? Now, next part. Suppose if in ETC, exchange traded derivatives. In exchange traded derivatives, there are three parties. I'll give you one more example. When you buy the shares in the stock market, you buy any share, let's say Reliance you buy, or any Infosys you buy. Do you know the seller? So who are the two parties now? You buy, buyer, and there is seller. But do you know the buyer and the seller? Do you know the buyer and seller? Do you know who has sold it? That's why you have bought it. You don't know. Why? Because there is a third party in between, that's called as exchange. Exchange, NSC we call it, NSC, right? NSC or BSC, anything. So there is a third party involved in this. So kindly note, third party involved over here will set the rules. Exchange set the rules, sets the rules, set rules. It doesn't let the buyer and the seller meet each other. It creates a pool of stocks and funds. So, this exchange always covers the credit risk. Credit risk is very important. Credit risk means what? What do you mean by credit risk? Here, over here, in OTC, there is always a credit risk involved. So here credit risk is covered. Okay? But in there, OTC, credit risk is always there. Why? Because, what do you mean by this credit risk? Here, I am buying the contract, I am buying the dollar, or I am buying anything. Let it be any commodity. I am buying it. So I'll give you money. Now the problem is, if you don't sell me that commodity, then so this is the main problem. Or reverse case is also true. I am selling and you are buying. So I give you the commodity and you don't pay me. Then both the cases are, so this is known as credit risk. Whenever the other party doesn't perform, it's called as credit risk. Okay, issuer problem. But this problem is taken care of in your this ETC, because exchange fixes both of them. It acts like a broker. Okay, so it will always fix both of them. Got it? So that's why ETC exchange traded this derivatives, okay, or OTC are between two parties and ETC are between three parties. Okay. Next, which of the following statements regarding over-the-counter derivatives is incorrect? Now look at this. I have just now explained you OTC. Now give me the answer. Which of them is incorrect? It is a decentralized trading market used by small companies. So decentralized trading market. OTC is obviously decentralized. Why? Because there are only two parties. Various banks. Let's say Bank A, Bank B, Bank C, three banks are there. Each bank will deal with separate customers, customer X, Y, Z. So they will set their own rules. X, Y, Z, they'll set their own rules. It's a decentralized market. Okay? Decentralized trading market used by the small companies. Generally it's used by the small companies. True. But what do you want? Incorrect. Your answer should be incorrect. This is correct. What is the second one? Trading takes place during fixed exchange hours. Fixed. Is there a fixed exchange hour in OTC between your bank and the customer? Does your deal take place only in between typical time? Banking hours only. You go to meet that customer later also. Then you decide. You speak to that customer. So there is nothing like this. So this is incorrect. And this is what you want. Trading does not take place. Trading takes place during the fixed exchange hours. That is wrong. Trading does not take place during the fixed exchange hours. In future market, see this, in forward it is between two banks only, two parties only. Me and that other party. So that other party, we may decide on the trade, on the meeting, or we may decide on the timing. Suppose if some customer is having, I am going to meet a Reliance client, Reliance, big client, or I am going to meet Infosys. And I'll say, I will come during 12:30 to 3:30. My timing of bank is between 10:30 and 3:30. I'll meet you between that only. I won't meet you later. Infosys will say out. Reliance will say out. They will say, whenever we have time, then you meet. We are having time in the evening, come in the evening. So no fixed hours. Whereas in future contract, it is a fixed hour. NSE, BSE, buying the stocks, shares. Can you buy it after 3:30? No. Because there you have fixed hours. Here you don't have. Okay? So this is wrong. But let's see others also. OTC doesn't have a specific physical location. Instead, persons involved in the trading directly negotiate over the communication network such as telephone. Obviously, that's what we do in banking, isn't it? Whenever you speak to the customer, you speak it over the phone, your email, your whatever, 1,000 calls are there, WhatsApp calling. Okay. Bonds and currencies are traded in OTC. Is it so? Bonds and currencies. So this is right. But is this true? Bonds and currencies can be traded in OTC. What do you do in forward market? What is a forward? Forward, whenever you book a forward for the customer, what do you do actually? You are actually booking the rates of the currencies. So that this is also true. So only answer over here is false. Trading takes place during the fixed exchange hours. That is false. Got it? Before going, kindly note the focus batch coming up on 21st. Join this immediately. Okay, without fail join this. Why? Because in the focus batch we are covering all the important numericals, objective questions, case studies, theories, everything. And fresh batch is starting. Also you can join this Mahapack. In Mahapack you are getting 15 plus batches per subject. 15 plus per subject. So that many times revision you have. You get ebooks. What else do you get extra? You get ebooks. This you get it in your class also, this batch also, and this Mahapack also. Ebooks, tests. You get everything over here. Tests. Okay. I'll show you. How to join this, that also I'll show you. See this, go to Atta 24/7. I'll always suggest you to go through the app. In the app, you get 1% extra. So always go through the app. Okay. So go to Atta 24/7. You'll come to the main site. Okay. Here, click on JIB and CIB. You'll come to CIB. Click on CIB. This is a focus batch. See this. Ebooks, mock tests, online live classes, best in class material, latest pattern. Latest pattern means even last year's paper is included in this. Okay, December paper. Self-paced learning, device compatibility, everything is there. How to use this? See this, use the code Y432. I have shown you on the slides Y432. Click on enter. Look at this. 80% discount you are getting plus 1% extra, 81%. How does 1%? This 1% you get it using your app. Download it through the app. Also, as I was telling you, Mahapack. Okay, join the Mahapack. Mahapack is one of the best options. You are getting 15 plus batches per subject. Okay, 15 plus batches per subject. See this, CIB Mahapack 2.2. Join this. Ebooks, videos, mock tests, online tests, everything. Okay, and 6 plus 6. You buy for 6 months, you're getting it for 12 months. You buy for 12 months, you get it for 24 months. Plus 81% discount is already there. This 81 is going on. Put the code Y432. Never forget a code for that. Okay? See this. 80% discount plus 1% through the app. So never miss this. Okay? And join the batch immediately. Focus batch starting tomorrow. Don't miss this batch. Very important one. चलो बाय.